Navigating the investment seas, the role of economic cycles in timing. In the intricate dance of financial markets, economic cycles emerge as the maestros orchestrating the rhythm of growth, expansion, and contraction. Investors, akin to skilled dancers, must not only comprehend the intricate choreography of these cycles but also adeptly time their moves to harness opportunities and mitigate risks. Understanding the pivotal role that economic cycles, notably expansion and contraction, play in investment timing is akin to mastering the art of precision on the investment stage. The expansive prelude. An economic expansion, often characterized by rising GDP, increased consumer spending, and burgeoning business activities, serves as the opening act in the investment symphony. During these periods, savvy investors position themselves to capitalize on the upswing. Stocks tend to flourish as corporate earnings expand, and sectors such as technology, consumer discretionary, and industrials often experience robust growth. Consider the technology boom of the late 1990s, where the dot-com era witnessed unprecedented expansion. Investors who strategically entered the market during this phase enjoyed substantial gains as companies capitalized on the burgeoning internet revolution. The wise timing of investments aligned with the economic expansion propelled portfolios to new heights. The contractionary crescendo. Conversely, economic contractions, marked by declining GDP, heightened unemployment, and subdued consumer spending, usher in a different tune for investors. During these downturns, astute investors reallocate their portfolios to weather the storm. Defensive sectors like utilities, healthcare, and consumer staples may become havens of stability, as these industries tend to exhibit resilience in the face of economic turbulence. The global financial crisis of 2008 exemplifies the challenges and opportunities presented during a contractionary phase. Investors who recognized the impending storm and strategically adjusted their portfolios to include defensive assets mitigated losses. Additionally, those with a keen eye for distressed assets found opportunities to capitalize on eventual market recovery as economic conditions improved. Timing the crescendo, cyclical and countercyclical strategies. The key to mastering investment timing within economic cycles lies in adopting cyclical and countercyclical strategies. Cyclical investments, such as technology or industrials, tend to thrive during economic expansions, aligning with the prevailing growth trajectory. On the other hand, countercyclical investments, such as bonds or defensive stocks, may act as stabilizing forces during contractions, providing a buffer against market downturns. For instance, an investor anticipating an economic upturn may strategically allocate a portion of their portfolio to cyclical sectors, leveraging the anticipated growth. Conversely, as economic indicators signal an impending contraction, a pivot towards countercyclical assets can help safeguard capital and provide a defensive posture against market volatility. Interest rates as conductors of the economic orchestra. The interplay between economic cycles and interest rates further underscores the nuances of investment timing. Central banks, as stewards of monetary policy, often adjust interest rates to influence economic conditions. During expansions, central banks may raise interest rates to curb inflationary pressures, potentially impacting interest-sensitive sectors such as real estate and utilities. In contrast, during contractions, central banks may lower interest rates to stimulate economic activity. This maneuver can make borrowing more affordable, benefiting sectors such as housing and encouraging businesses to invest. Investors attuned to the central bank's interest rate movements can strategically position their portfolios to align with the prevailing economic conditions. Global synchronization and diversification. In an era of interconnected global markets, the synchronicity of economic cycles across countries adds an additional layer of complexity to investment timing. Diversification, a timeless principle in investment strategy, becomes particularly crucial in navigating the varying rhythms of economic cycles worldwide. Allocating investments across regions and industries can help mitigate risks associated with localized economic downturns. For instance, an investor heavily concentrated in a single market may face heightened risks if that market experiences a contraction. However, a diversified portfolio spanning geographies and sectors can act as a robust shield, ensuring that the impacts of economic cycles in one region are balanced by opportunities in others. The technological overture. Adapting to disruptive cycles. In the contemporary investment landscape, the advent of technological disruptions introduces a new dimension to economic cycles. Sectors experiencing rapid technological advancements may undergo cycles of innovation, growth, and consolidation at an accelerated pace. Investors must adapt to the unique cadence of these cycles, recognizing that the traditional markers of economic expansion and contraction may be augmented by the disruptive forces of technological evolution. Consider the rise of electric vehicles as a disruptive force in the automotive industry. Investors who accurately gauge the trajectory of this technological cycle position themselves for substantial gains as electric vehicle companies experience exponential growth. The ability to recognize and align investments with these innovative cycles can prove instrumental in navigating the evolving contours of the modern economy. Conclusion. In the grand symphony of investments, economic cycles serve as the sheet music that guides investors through the highs and lows of financial markets. Mastery of the art of timing involves an acute understanding of the distinctive movements within expansions and contractions, coupled with a strategic blend of cyclical and countercyclical strategies. As the economic orchestra continues to play, investors who harmonize with the changing rhythms leverage global diversification and adapt to technological overtures will find themselves not just spectators but active participants in the ever-evolving performance of the investment world.